Hey, everybody, we're going to get started in just a minute. We just want to give folks another chance to pop into the webinar, and hopefully we'll get going by about 6:01. Thank you so much. Awesome. Well, listen, thank you all so much for showing up on a pretty sunny evening in Boston. My name's Emily Patrick. I work for the City of Boston Small Business Team. And I'm really excited. For the team we're working with tonight and over the course of the next several weeks and months to put together this workshop for established restaurants in the city. So just really briefly, I just want to go over a little bit about what our team at the city does. So I work for the Office of Economic Development Small Business Team. And I'm one of 15 full-time staff members whose job is pretty simple. It's to help small business owners in the city of Boston. And we do that a lot of different ways. We have institutional knowledge. Some folks on our team have been with the city for over 20 years. They're able to answer a lot of questions, make referrals, tell people where to go, answer questions about permitting and licensing and all that stuff. And then we also have a budget that we're able to spend on some programs that we have. So one is our Boston Main Streets program. We have a restore and design program for brick and mortar businesses. And we have a technical assistance program, which we use to hire outside consultants to present webinars and workshops for one, and also to work one-on-one with folks who maybe have a critical need. And I've been really lucky over the past year or two in my role here to work with some excellent people over at Commonwealth Kitchen. Both supporting small business owners who've become like some of the closest constituents I've ever worked with. And now this year, excitingly, to be able to hire CWK to put together some webinars for folks in the community. Because what we've heard throughout COVID and everything that's been going on is the need to support people where they are and meet them where they're at and provide services to them to kind of get them over this hump and help help address the needs that they're having. And so we're really excited to bring CWK on board as a technical assistance provider. And so I want to introduce two awesome folks from their team who are going to talk to you a little bit about what tonight and the next several weeks down the road will look like. Do want to mention for folks that we are recording this. So you will be able to, we'll have this as a resource in case you want to rewatch it. We'll be able to share it with other folks as well. But if you do go off mute, know that it will be recorded. I usually make there's a bathroom on the left joke, but I already made it, so I can check that off my to-do list. And my last thing to do is just to introduce the two folks from CWK. So Irene and Jessica, thank you guys so much for partnering with the city to put this on. We're so excited to be working with you on this.
Thank you so much for having us, Emily. Hi, everyone. My name is Irene, and I am here with my colleague, Jessica, from Commonwealth Kitchen. Some of you may know me from my role at May, first as Street Kitchen, which was our food truck, and then as our restaurant. So I have been running my own food business with lots of help for the last 8 years. And I'm now the project manager for the Restaurant Resiliency Initiative at Commonwealth Kitchen. And so we are going to be doing 4 or 5 webinars over the course of the spring and early summer. And we are really excited to make them all as actionable and useful as possible, because I know we've all been to lots of very useless webinars before. I'm especially excited to host this tonight because for too many years, I was terrified of looking at our books at May, and I was also terrified of our accountant. I kept pretty much all of our invoices in a shoebox, and once a year we gave them to the accountant, and I would use my best judgment to determine how our business was actually doing. And usually if there was money in the bank account, I said, okay, that's good enough for me. But once my team, especially my business manager, Kaden Salvata, who appears to be here in this webinar 8 times over. Thank you, Kaden, for showing up in full force. He helped me really see that checking the P&L, the profit and loss statement regularly, can be really useful and even a little bit of fun. So as I started to get more comfortable with the books, I realized that the financial data could really help me make decisions, and especially the kind of decisions that I used to argue about with my co-owners, my big brother and my big sister, all the time. So things like, should we close on Mondays? Should we 86 this dish from the menu? What should we pay our new line cook? And so suddenly with the books, there was a lot less to argue about because the P&L really told us what to do. It's also great to look at the numbers because it can help you prioritize, right? And in restaurants, everything is a priority all the time, but you only have so many hours in the day. And so you have to be smart about how you spend your time, and the numbers let you see how your efforts pan out, which is, I think, one of the most rewarding parts about getting comfortable with the financials. So needless to say, I'm thrilled you're all here. For a couple housekeeping items, we're going to take questions throughout the webinar. You are welcome to throw them in the chat or put them in Q&A. You can DM me directly, and I will either interrupt Dylan or save them for the end. And then I will just pass it off for a moment to Jessica to tell you a little bit more about restaurant resiliency.
Hi, everyone. Thank you all so much for joining us tonight, and a huge thanks to the City of Boston for being our partner on this program. I hope that many of you who have joined us this evening are familiar with Commonwealth Kitchen, but if not, just to give you the little mini spiel, CWK is a nonprofit food business incubator. We're located in Dorchester. And last year, we started working with some wonderful restaurant partners throughout the city, thanks to my colleague Roz, who's here with us this evening as well, to do emergency food work in response to COVID. So out of this program grew the Restaurant Resiliency Initiative, which is a new entrepreneurial track at Commonwealth Kitchen to specifically support restaurants and their unique business needs. It's being led by Irene in partnership with Dylan, who I'll ask to introduce himself in a moment. And we've had such wonderful support from the City of Boston, which is why we're here tonight. So if you are interested in learning more about this, please visit our website. We'll follow up with you all after this event this evening, and stay in touch. Commonwealth Kitchen is here to support diverse entrepreneurs in the City of Boston and Greater Boston. And we're just thrilled to have you all here this evening. So thank you. And I'll pass it over to Dylan.
Wonderful. Thank you very much, everyone. Excited to be here. I think we'll aspire to be slightly better than the criminally boring webinars that Irene alluded to. So first off, let's answer right away. Well, actually, let's make sure, here we are, make sure the slides are working. Let's right away answer the question that was admittedly a bit of a clickbait title to the webinar. Can I trust my accountant? The answer is probably yes. So anybody who came hoping that we were going to start beef with accountants, I'm sorry to disappoint. But if accountants are in general a trustworthy bunch, then why do a lot of folks have some hesitation or not really know if they can trust their accountant or not? In our experience at Rethink, it really comes down to a couple of things. One being a lack of communication or ability to communicate, a sort of a shared language. And then the other is a lack of clarity around roles. Who's responsible for what when it comes to the financial picture of the business? If you can wrestle with those two questions and come up with a little bit of clarity, then you'll probably be on the right track. So tonight, next 45 minutes or so, we'll do our best to give you a little bit of structure that you can fall back on with your relationships with accountants and bookkeepers and other financial services providers, and also give you a little bit of language so you can bridge that potential communication gap that likely exists in your current relationship, or does exist in many relationships. So now that we've gotten that disclaimer out of the way that we're not here to bash accountants, who am I? I'm one of the partners at Rethink Restaurants. For the context of this webinar, very importantly, I'm not an accountant and I'm not a restaurant owner. Why me then? Well, my role a lot of the time with clients, particularly early on in a relationship with new restaurants that we work with, is my role. I can kind of speak restaurant and I can speak accountant. So I often fill that translator role in the relationship and try to, like I said before, establish that communication and allow restaurant operators and bookkeepers and accountants to have a productive relationship with structure that's going to work for everybody. I guess by way of disclaimer, I would say that if there's anything in here, if you've read up on accounting, you went to accounting school, there might be something in here that you say, well, technically that's not quite true. You're probably right. So this is much more practically sort of how does your relationship go with an accountant and a bookkeeper. Yeah, any accountants out there, happy to have feedback afterwards. Why bother, right? Why bother with the finances? I think a lot of folks run perfectly successful businesses without spending a lot of time with their numbers. I would say most of those cases, those people are, doing it through brute force, and a lot of effort and love, and that's great. But falling back on the financials, using the financials for something other than tax purposes, is what we're after here. So there's a version of your finances that Uncle Sam cares about, and that's great. But there's a version of your finances that can be really useful for you. I sometimes think about a well-organized set of finances as a manager who just happens to not be paid. The insights you can gain from well-organized finances are that valuable, and help you make informed business decisions that can be hard to make if you're doing things sort of based on feel. A lot of operators will say, I have a great sense of what's going on. I'm in the business 14, 16, 18 hours a day. I know what's going on. And while that can be true, it can also be true that there's sort of a different lens to look through. And that's the lens of the finances that provides a slightly different sort of opinion on what's going on. So you can sort of cross-reference what you're feeling is happening with what at least the numbers say is factually happening. Okay, so Dylan, that sounds great, but I don't have an accountant, I don't have books. I got a shoebox full of invoices like Irene. What do I do? Well, the answer might be, or our answer might be dissatisfying for some. My first reaction would be probably hire someone. Oftentimes we hear, it's something I'll figure it out. I'll do it on my own. And while that's possible, I have known operators who've successfully done their own books and created accurate, prompt financials. It's probably not the best use of your time as an owner or a manager. Bookkeeping is a very time-consuming process. Even if you do it well, and especially if you don't do it well, it can take a lot of time that could be better spent working on your business in other ways to strengthen it. Also, bookkeeping, there's a reason why people go to school for accounting. There's a lot of little details. On the fly, you can learn sort of the broad strokes, but if you do learn it on your own, you're likely to be making small mistakes along the way that are sort of undermining the value of your numbers. So it really is probably the best choice to hire someone. And we know it's not cheap. It's a lot more attractive to do it for free yourself. But I think there's opportunity cost there that needs to be appreciated. So we encourage folks to think of hiring someone to do their finances, handle their books as an investment in the company. That buys you some of your time back. It also buys you knowledge, and that knowledge can help you make, as I said before, more informed decisions that will likely pay many times over for what can seem like an expensive service at the get-go. Okay, so enough preamble. The point, 10 things to know, mistakes to avoid, common stuff we see people struggling with. You know, there could be a lot of different titles for this. These are probably the top 10 things that people are often struggling with. And we're going to sort of start high level, and then we're going to get into some detailed ones, but they all are pretty important. And after tonight, you come away not necessarily remembering each of these individually, but knowing that you can have a relationship with your financial service providers. You know, there can be a dialogue. You can ask them for things. You know, there can be sort of a give and take rather than just waiting for reports to come out of a black hole. That in and of itself would be a pretty good takeaway too. But since there's going to be a recording of this, you could go back and sort of methodically go item by item. And if you address each of these 10 things, you're probably going to be in a fairly strong spot when it comes to your finances. Okay, so real high level. I've referred previously to bookkeepers and accountants, financial service providers, sort of interchangeably. Who are they? What are their roles? Let's talk roles first. And there are probably exceptions to these, but I think in broad strokes, first starting with your bookkeeper. Your bookkeeper records your transactions, keeps you organized, most importantly on a regular basis. So they're doing work for you every week, every month, probably no less often than that. If they're doing work less frequently than every month, they might not be the best bookkeeper. So we're looking for prompt, accurate financials from your bookkeeper. So you're communicating with them on a regular basis. If you're not, you're leaving things up to guesswork for them. So they're probably not going to go out of their way to communicate an awful lot with you until you set that expectation. But you know, they're going to have questions about certain transactions. What is this transaction for? Is this payroll? Is this a subscription you bought? So there needs to be some amount of dialogue, and it's probably going to be on you to establish that dialogue with your bookkeeper. Really good bookkeepers will do that proactively, but I would force the issue. And then next, your accountant, your CPA. They're generally going to be doing work for you once a year around tax time. There could be plenty of other good reasons to talk to an accountant throughout the year. But once again, sort of as a general structure, talking to your bookkeeper all the time, talking to your accountant once in a while. And part of the reason for that is just, like I said before, to establish roles. But another really good reason for that is accountants are more expensive per hour generally than bookkeepers. So accountants, making sure accountants are just doing accountants work and no other work, and bookkeepers are handling the rest, will be the most cost-effective way to use each of these folks as well. Okay, so this one, cash versus accrual, is maybe the most technical item on this list, number 2. You could Google the difference between cash versus accrual. I could have put the definition from Google on the slide, but I think for folks who don't have a ton of familiarity with finances, the definition is not particularly helpful. It has to do with when transactions are recognized. Is it when the goods change hands, or is it when the money changes hands? That's kind of the root of it. But the important part to take away here is, like, what do I care about? You're going to mostly, as an owner and a manager, your interest is in accrual-based P&Ls and accrual-based reports. Accrual-based reports or pulled on an accrual basis might be what you hear your accountant say. Those are going to be a more useful representation of what's happening on a daily basis, and they're going to be more useful for making those management decisions that we talked about before, or that I mentioned before. The accrual books can be managed by a bookkeeper. I would hesitate to say that your bookkeeper can do accrual-based accounting, because if they're maybe not so good at bookkeeping, they might not know how to do it. So that's another sort of marker of, like, is this person highly competent or not? So I would ask them, can I get my reports on an accrual basis? If the answer is yes, you're probably in good hands. If the answer is no, it's for one of 2 reasons. Either they don't really know how, because managing books for accrual accounting is a more technically challenging thing. There are more steps. And in that, it's also more time consuming. So they might also just be being kind of cheap. If you feel like you're getting a bargain accountant, or excuse me, a bargain bookkeeper, they probably are doing your books on a cash basis, which is not particularly useful for you. So bargain hunting when it comes to bookkeeping can be a mistake, because you get bargain books, but if they're cash basis, you can't use them for much. Opposite, accountants care about cash basis. So that's what they use to file taxes, and that's great for them. It needs to exist for those reasons. But your focus as an operator, you want to be looking at accrual-based accounting. We could really go into the weeds with this. There's probably a lengthy conversation that we could have about it. But as a starting place, you want accrual. Yeah, we'll stop there for now. All right, number 3. Profit and loss statements, or P&L versus balance sheet. Again, what do I care about? What do I need to look at? What am I looking for? Prior to the pandemic, I would say that very few operators, even those who took their finances seriously, spent much time with their balance sheet. The balance sheet is the one here on the right. The balance sheet includes more, people might consider more abstract ideas, things like assets, liabilities, equity, these things that are a little more, they're sort of separated from like the functioning of the business. Those things are important for understanding the overall health of the business. They have a place, but it's not a report you're probably going to be looking at all that often. The exception there, it has useful information about cash flow. So if you're having cash flow issues, you might be spending more time with your balance sheet than you would otherwise. But really, for management purposes, for improving the business, on a daily or weekly basis, your meat and potatoes is your P&L, the profit and loss statement, which is on the left here. So if the balance sheet is abstract, the P&L should be, you should see the business, or I shouldn't say you should. You can see the business if you spend time with it and learn sort of the story it's telling. You should be able to see the business happening there. The numbers should tell you a story about what you're experiencing in person. So it's got things like revenue, it's got things like cost of goods, labor, things that are a lot more related to the day-to-day function of the business, as opposed to long-term liabilities, which are, that's for another day. So the difference there is important. You're spending, 90% of your time every day, every week, every month, looking at your P&L and occasionally checking in with the balance sheet. Actually, one quick point on that. An accountant who's doing you a lot of services will flag you on issues in the balance sheet. So that's one place to set those expectations. Hey, if my cash reserves get to a certain level, or I have outstanding liabilities of a certain amount, I want to know about that. That can be a really productive way to use an accountant or a bookkeeper. And that whose responsibility that is probably for you to establish between them. I'd probably lean on the accountant for that, because it is critically important to understand, do I have a bunch of bills outstanding? I really ought to know that. Okay, so if we're spending a lot of time with the P&L, it better be useful at a glance. You're not going to have a ton of time. You got to run a business. So how can I organize this report to get what I need from it in 5 minutes or less, basically? The basic structure we're looking for is what we call a 5-line P&L. A P&L, when it's expanded and has all your stuff in there, can be 100 lines. But we're looking for 5 key ones that we see at a high level. Those 5 being revenue, cost of goods, direct labor, overheads, and net operating profit, which can also be a loss. Net operating profit can be a negative number. So if you can see those 5 things, and you don't have to do any mental gymnastics, you don't have to pull out your cell phone calculator to say, well, that's mostly direct labor, but there's a little labor over here, so I got to add it in. No, it should be plainly stated. And that's a request that you can make clear to your bookkeeper, that your expectation is that it's nice and neat for you to be able to look at a glance. Okay, so now we're starting to get into more detailed ones. Oh,
I was just going to say, going back to the prior slide, if that's not how your P&L looks, your bookkeeper knows how to make it look like that, and you should just tell them to. So want to make sure everyone here knows that they have permission to do that.
yeah. Yeah, your bookkeeper, it's a lot easier for a bookkeeper not to do extra work. So if you don't ask them for something special, they're going to assume what they're doing is fine. Make your expectations clear. Thank you, Irene. That's good. Okay, so here's one that, even if you have that structure perfectly, if you start incorporating what seems like little errors, it can be just as damaging as not having reports at all. Making decisions on inaccurate information is probably just as bad as making decisions with no information at all. So one of those issues is including meals tax and tips in revenue. That's a mistake, and that is incorrect. Meals tax, tips, credit card interest is another one, I think, that where you get paid credit card points. Those things should not appear as revenue. Meals tax and tips, these things are liabilities. You can think of it as you're collecting that money on behalf of someone else. You're sort of a pass-through. So you're collecting that money, but you owe it elsewhere. So it appears on your balance sheet, but it very much should not appear as revenue. It's never your money when it comes in the door. It's not your money when you're paying it out. You're just sort of the short-term bank for it, and then the delivery person. So it's not revenue. There are probably other things that aren't revenue, but those are probably the two biggest ones that we see sneaking in there. Okay, so this one about third-party fees requires the most in-depth explanation. So I'm going to try to go a little bit slower here. So third-party fees should not be used to reduce revenue. That statement in and of itself might be a little confusing. So I think this one is better explained by way of example. So if we look on the left here, month one in this business, they did $1,000 worth of revenue, and this was all in-store. So in-store sales were $1,000. Total revenue was $1,000. In terms of cost of goods, they had to purchase $250 worth of cost of goods materials in order to produce that $1,000 worth of revenue. Direct labor and overheads are zero, not because that's realistic, but because we want to focus strictly on the example at hand here. So we're just focusing on the relationship between revenue and your cost of goods expense. So when we're looking at cost of goods in relation to revenue, we would say that $250 of cost of goods compared to $1,000 of revenue means your cost of goods percentage is 25% of revenue. So we just get that by taking 250, dividing it by 1,000, moving that decimal place over, and we get 25%. So this is, you'd say to yourself, okay, 25% is a pretty solid cost of goods. I feel good about my numbers. We're on track, right? Now, same business, month two, maybe a pandemic hits, and all of their in-store sales have vanished. You can see here that number has gone to zero, and they're doing all third-party delivery. So they've got $1,000 worth of third-party delivery. They've created just the same amount of revenue there as they did in the prior period. Now let's skip down for a second to cost of goods. Cost of goods is still $250. So $1,000 worth of revenue is created. Cost of goods is still $250. In person, in reality, the same thing. It's identical to the month prior. Where the issue of removing third-party fees becomes an issue is right here. So we have $1,000 worth of revenue, but we're going to reduce it by the third-party fees, which traditionally have been like 30%. So we'll use the example of 30%, we're going to reduce that, reduce the 1,000 by 300. That gives us an actual revenue, or shown revenue, I should say, of $700, which creates the problem. When we do the exact same process, we take the 250 as we did in the prior month, we divide it by total revenue, but instead of dividing it by 1,000, we're going to divide it by 700. which shows us a cost of goods percentage of nearly 36%. So if you went from 1 month where you have 25% cost of goods, and the next month it shows almost 36% cost of goods, that would probably lead you to make some drastic action. You might go say, we have to retrain our prepper. We need to call up our vendors because they're ripping us off. We got to talk to the chef about over portioning. You're going to go into crisis mode because on paper your business has taken a big hit. Something's gone drastically wrong. But that really would be accounting noise, and that would be you being misled. So what that should look like is as follows. If you were to edit that period and show it with proper accounting, with the way we would advocate it, you'd get rid of those third-party fees that are in revenue. So that minus 300 would go away. Your revenue would return to 1,000. But we still need to account for those third-party fees. So those third-party fees are moved as an expense down to overheads. The end result is that our cost of goods percentage returns to the 25% that it was the month prior. We've just sort of reorganized the numbers so we don't go into crisis mode thinking that our cost of goods has gone wildly out of control. Irene, you look like you want to jump in.
Yes, I do. Thank you, Dylan. So I just wanted to underscore that I think this one is really important because it shows that even though you bring the same money in and you pay the same money out to your third party, the way that the profit and loss statement is organized can either give you really useful data, which is like, oh my gosh, your COGS were really consistent. That's so great. Or it can give you data that's really misleading. And so, if I saw these numbers, if I saw COGS skyrocket like that, I would, pull the fire alarm and say we need to fix a bunch of stuff. We also had someone ask about whether merchant account fees should go under COGS, and I will test my knowledge here and say that they should not. They should go under overheads, ideally for the same reason. I don't think you would see as drastic an issue as you might with third party because third party takes such a big cut. But what do you think, Dylan? Am I right?
I think that's one of the very few of these questions that I could go either way on, honestly. I think there's a very good case to be made either way. The important thing there is if you commit to one or the other, number 10, I'm giving away part of it, remain consistent. So there are some things that you shouldn't remain consistent doing if you're making big mistakes. But that one that is much more the art of bookkeeping and less the science of bookkeeping, I would remain consistent with that. I think it's pretty reasonable to say, well, every time the card is swiped, I'm paying. I'd say go ahead, that's fine. But then again, I'm not an accountant. I'm just trying to make the numbers useful. So I would say they would be useful either way, as long as you're consistent. Don't waffle back and forth.
Thanks for that question, Justin. And I also just wanted to let everyone know, I forgot to say this earlier, but Dylan is totally fine, even though he has turned a little bit pink. This is totally
normal.
So
I forgot the disclaimer. It's because I care so much.
Yes, exactly.
I forget to breathe and I turn red. This is par for the course. I'm not having a medical emergency, but I appreciate the concern.
Yeah. So, everyone who's in my DMs asking if you're okay, he's fine. So don't worry.
Yeah. Oh, that was the disclaimer. I usually say, or I was going to say with the picture at the beginning, like, see that face? It's going to get like more darker and darker shades of red. I'm all good. Don't worry about it. But I do appreciate the concern. All right, let's move on from third-party fees. Enough of that. We can answer more questions about it toward the end if you want. All right, so this one's hopefully a little bit easier, a little bit simpler than the last one. So this is sort of a twofer with regard to cost of goods. The first thing is cost of goods should only be the cost of ingredients and necessary packaging. Nothing else should be in there, especially during COVID, where many businesses switched to a lot more takeout, delivery. There's a lot more packaging involved. Making sure all of that packaging is making its way into cost of goods is key. Anything that's a one-time use that your guest walks out the door with, or it's a disposable your guest uses, that's going to be a cost of goods. It's the bag they take their takeout in. It's the napkins that go in it. All that counts. If there's glassware or something that they're using in person, if they're dining in, That stuff's reused. That does not live in cost of goods. That lives elsewhere. And then a second point on cost of goods has to do more with, how do I think about cost of goods in relation to my menu prices? So the traditional, or maybe not traditional, but outdated advice is something like your menu price should be 2.5 to 3 times your cost of goods. And I'm sure there are some concepts out there that are making that work still. But realistically, especially in Boston proper, if you're doing business at 2.5 or 3 times cost of goods, that's a miracle. And what I mean by that is the old advice would be, if the dish costs you $2 to produce, you'd put it on the menu for something like $5 or $6. In reality now, it needs to be more like something that costs you $2 to produce is going to be on the menu for something more like $7 to $10. And that's just a reality of increasing wages and rents and all the different pressures that are on businesses. The cost of goods as it relates to menu price, that multiple's got to go up to allow room to operate a healthy business, to pay people appropriately, that sort of thing. And that's not every item on your menu. That's sort of on average that should happen. There are always exceptions where the market won't necessarily bear a 5 times multiple on a steak. It's probably not going to happen. So within reason, that's important. Again, Irene, you've popped in.
Hi, yes. I just wanted to add that I think this is one of the things that surprises guests the most when they find this out. And if you're someone who doesn't have a background in the restaurant industry, you might be surprised when you open your restaurant and learn this, like I was when I opened my restaurant. So I think that it's important to make sure that folks on your team also have a sense of this. And for guests, so often you'll get a Yelp review that says like, I could have gone to the grocery store and made this dish myself. And the truth is like, yeah, you could have, but you didn't. You came here, you sat in our air conditioning, you used our credit card processing, you were served by our staff. So this is one of my favorite fun facts about the restaurant industry. And so tracking kind of what people say about it over time can be really interesting too.
Yeah. Yeah, and I guess the final note on that is don't be afraid to get paid. You need to make the business work. You can't be giving things away, and to make it work, you need to be charging something like these amounts. And if people have issue with it, like Irene said, they can go make their food at home. They might not make sense to them to dine with you. All right. So how about owner pay or lack of pay in some cases? So how do I treat owner pay? How do I think about that in relation to my P&L? Where does that live? There are 3 points here, 2 of which are shown, and 1 is something more to keep in mind. So if an owner is paid and their time is spent working in the business, they're serving some role that you otherwise could hire another staff member to fill. They're working the register, they're greeting guests, they're cleaning, they're doing whatever. If they're working in the business, that pay is direct labor pay. So that would go live in the direct labor expense category. If the owner works on the business, they are negotiating with vendors, they're planning for expansion, they're doing whatever, something like those 2 things, their pay would live in overheads. And you can also split pay. I wouldn't get too broken up about this, getting down to fractions of a percent, but being able to say, yeah, I spend about 25% of my time working in the business, and then 75% of my time working on the business. Communicating that to your bookkeeper, making sure that they know within your payroll system, where you are or wherever your owner pay is taken, so they can divide that and attribute some of it to direct labor and some of it to overheads. I generally say that if you're able to say 75-25 in either direction or 50-50, I wouldn't necessarily get more detailed than that. But just trying to categorize it somewhat accurately to say, here's really where I'm distributing my time. And then the last thing is, if an owner is not being paid, that should be taken into account. If an owner is not being paid, or any staff, your brother comes in and works for free sometimes because he's nice, that missing from the P&L might give you an unrealistically rosy outlook on what's going on. In those cases, you could either manually, after a report is drawn, add that line in, even by hand, or just mentally say like, well, what happens if I paid myself, $1,500 this last pay period? Like, do things still look good? Keeping that in mind and making sure you don't get misled, because there might be perfectly good reasons for an owner not to be paid for a period of time, but that's not a long-term sustainable thing. So eventually the business needs to be able to accommodate pay for them. So what does it look like if the business accommodates pay? Is the business still viable or not? That's a pretty important thing to keep in mind. All right, home stretch here. So balance sheet items sneaking onto the P&L. This is one that really can get lost. Overheads, balance sheet items often sneak onto the P&L in the overhead section. And the overheads are a complete snooze. It's your utilities, it's stuff you think about once a year or once a lease cycle. And so you really need to take the time once in a while just to make sure that your bookkeeper hasn't accidentally put something into overheads that doesn't belong there. Pretty standard examples would be something like renovations or purchases of significant machinery or equipment. Those things that are bigger price points, that are an investment in the business sort of for the long term, or at least for years, those things should be spread out over time. You shouldn't have the $25,000 renovation hit you in April and make your April numbers look horrible. That cost should be spread out over time. And again, your bookkeeper should know how to do that. Making sure they do know how to do that, again, would be a signal of whether they're really adept or not. So combing through there once in a while to make sure items that shouldn't be there are not. And then lastly, being consistent. Being consistent in a couple of different ways. So being consistent in the way that you categorize things. The example earlier of the merchant fees is a great one. Whatever you are comfortable with, whatever makes sense for you in that case, that one's more a matter of opinion, and more than I'd care to admit or would like. There's a lot in bookkeeping that's a matter of opinion. So if you've chosen to do it one way, stick to it, and that'll allow your reports over time to be apples to apples. If you waffle back and forth on any matter of opinion, it's going to be really hard to use your numbers and say, okay, I can trust that I'm making progress, or I can trust that there's a trend when you're introducing variables on your own. And then being consistent in using them. If you're going to go through this effort, you're going to sit through this webinar, you're going to hire an accountant or a bookkeeper, you're going to take the time to facilitate the relationship, you're going to invest in this, you ought to use it. The numbers don't have any value sitting in your QuickBooks file doing nothing. They need to be used by you or your management team as a way of measuring what's going on. They can be a really useful scoreboard. So weekly, monthly, probably no less frequently than monthly, you got to be looking at them, or else your effort is probably not worth it. And that, like I said before, it'll consistently allow you to identify trends and opportunities and improve your business in an educated way, as opposed to relying on feel all the time, which can be a lonely place to be. Okay, so we crammed them all in here because we were afraid some people might get the slide deck and not the presentation. So this is definitely not the sexiest slide I've ever produced. But this is the summary of all of them. And we could go through it, but I think I'd rather get to questions. This is the summary of all 10. This is not a comprehensive list. I'll say that one more time. These are just probably the top 10 things in working with independent restaurants that time and again, we're always touching on when going through folks' numbers. Lastly, would be next steps. Only City of Boston businesses are eligible for the time outside of this. But regardless, if you have questions about like, who should I talk to be my bookkeeper? And I don't know. Do you have someone you trust? We have people we've worked with before that we'd love to refer you to. people that we trust and have handled clients well in the past. So even if it's not to set up a time with us, if you have questions related to this, please reach out to Irene at that address. And in your email, if you are looking to receive some time, put your business name, location, and then if you have books. Happy to talk if you don't have books, but it's probably a much more productive conversation to say, okay, here's how you go get them. But if you do have books and you have some specific questions, either about the 10 things we talked about or other specific questions, we could go through them together as long as they exist. It's pretty hard to go through books otherwise. All right, I think that'll do it.
Great work, Dylan.
Questions coming in. Thank you.
Yeah, we have a few questions. I think one thing I wanted to say just briefly about the next steps. So for folks who are in the city of Boston, we are able to offer some one-on-one consultations / hangouts with Dylan here. And we're really excited about that because I think the way I would suggest thinking about it is like a checkup on your P&L, and also maybe a checkup on your bookkeeper's performance. So Dylan is really, really good at spotting some of these problem areas that might be making your P&L less useful than it could be. And so he is a great resource. So hoping that we'll hear from lots of people who would like a P&L checkup. And I think now we'll dive into some questions. We have a question from Milton. Hi, Milton. He is wondering, how often can you legitimately ask for a P&L? So I guess how often is it okay to ask for a P&L? Yeah,
that's a good question. Just because I mentioned at one point your bookkeeper should be doing work on a weekly basis, or at very least a monthly basis, on a monthly basis, it doesn't mean they're producing reports for you every week. You could ask for sort of preliminary information, but if you operate on a 12-month schedule, looking for reports at the end of every month that are polished and the bow is tied on those, that's what I would be looking for. More frequent than that might be unrealistic. So I would also look for them. I said accurate at the beginning. I also said prompt. If your bookkeeper gets you reports for April in July, that's not good enough. They should be getting reports to you within 2 weeks, ideally within a week or 10 days of the end of the period. If it's less frequent than that, I'd let them know you're not that happy and you want them more frequent.
Awesome, thank you. We had a really interesting question from Alex about, Alex said he said, I remember being told to include non-administrative labor in COGS. And I think that is how some industries handle labor. I don't know if you want to go back to one of the 5-line P&L slides to show that, but folks might have their labor wrapped up in COGS.
Yeah. So on the P&L, so I guess actually to answer the broad question first, yes, what you said is true. I think it's standard in manufacturing and other industries for hands-on labor to be counted as cost of goods. On your P&L, depending on your accounting software, the parent category might end up being cost of goods that direct labor lives under, but it should be very much visually separated and clear that labor and cost of goods, are completely separate. So there, you've pointed out, I'd say, in my view, sort of a limitation or what creates a little confusion in some accounting softwares. You might see it placed in an odd way, but as long as it is, you can draw a box around it and you just see direct labor and you just see cost of goods alone, that's good enough. But yeah, good point.
Great. Okay, we have an excellent question. Actually, we have 2 questions about pricing. So how much do competent bookkeepers generally charge? And would asking for monthly reports from them drive up the price at all?
If they're cheap, the answer to the second question is probably yes. So competent bookkeepers, I have yet to find a bookkeeper who produces prompt, accurate financials for less than $500 a month. I should have said this earlier, so thank you for asking the question. I meant to. If you find a bargain bookkeeper, I've met a lot of people who've got a bookkeeper for $100, $150 a month. They're very likely producing books on a cash basis, which is not particularly useful for you. And they're probably delayed by quite a lot. So if you are able to find a bookkeeper that produces prompt, accurate financials on an accrual basis for less than $500, you should tell everybody, because everybody should use them. I'd say the range, the low end of the range is probably 500 to 700. And then if they're wrapping some amount of like financial advising in there, there are bookkeepers who are charging a reasonable amount, even up to $1,200-1,300 a month. That would come with some extra stuff probably that you may or may not need, but your floor is probably looking around $500.
Yeah, and I think one thing that folks can do is make sure that they have a bookkeeper doing bookkeeping and not their accountant doing bookkeeping, right? We talked about this a little. But so if you have your accountant doing your bookkeeping, you can always ask them if they have someone on their team who is a bookkeeper, who would charge as a bookkeeper, or you can potentially go elsewhere for bookkeeping, right, Dylan? It doesn't all have to be within the same house necessarily.
Yes, I'd say half of folks I work with, their bookkeeper is a completely separate company from an accountant. And as long as expectations are made clear, that arrangement can work quite well.
Great. We have a question about where marketing expenses would fall on the P&L, and if there's a benchmark recommended for percent of revenue to be spent on marketing.
So the answer to the first part of the question is marketing lives in overheads. There are, you can break out overheads further, marketing being a piece of the way you'd break it out. The benchmark, I mean, in general, I always cringe a little bit with benchmarks because, restaurants are so varied, that a cafe that produces everything in-house versus a cafe that orders everything pre-made, you can't, even within cafes, you can't really give an accurate benchmark for those two businesses. They're going to look very different and be healthy looking very different. But if you invest heavily in marketing, I'd be surprised to see you spending more than a couple percent of revenue on marketing. I think that would be a pretty hefty spend. Yeah, that would be, in a $1 million business, to keep the numbers round. If you're spending more than $20,000 a year on marketing, I guess they better be good.
Sweet. Thanks, Dylan. Okay, we have a couple of questions that are a little bit out of accounting bookkeeping world, which I think is great. So Adam from the glorious Bucktown in Providence wanted to know, how do you think about the relationship between COGS and prep labor on an item by item basis? For example, steak or lobster roll have low labor, high cost of goods. Any rules or things to think about there?
Yeah. So it's always tough. I guess you can really break down, like, we're just going to focus on labor, we're just going to focus on cost of goods when you're evaluating any piece of the business. I would say for low labor items, tolerating a higher cost of goods percentage is a reasonable place to start. I think an example that might that I find useful for this is thinking about, like, the muffins that sit by the register, at a cafe. If you sell muffins for $1.50 or $2, and your muffins are 40% cost of goods, 50% cost of goods, and you're buying those pre-made, I wouldn't be too concerned about that, because the amount of labor it takes to sell that is, say someone says, hey, I'd like a muffin too, boom, muffin in a bag, they're off. So that's really low labor, and I would tolerate a higher cost of goods. And I think conversely, if something requires a ton of prep, it takes 3 days to make, a bakery that makes bread from scratch or bagels from scratch that go through the 3-day process. Yes, that's flour and water and yeast, in terms of its components, but all those hands that touched it and all that time that went into it, I would expect to err on the side of a lower cost of goods percentage. So that might be, for some folks who haven't thought about this stuff as much, that might be a little bit more of an advanced kind of way of thinking about this. You're layering multiple pieces of the P&L on top of each other. But yeah, as a general rule, I think that's fine.
Thanks, Dylan. We had a question from Drew from Exodus, some of my favorite bagels in the whole world, about whether disposable baking sheets should be considered part of cost of goods if you use a new baking sheet every time you produce the item. I gave an answer in Q&A, but I'm curious to see what you would say and if I answered correctly.
My gut would say yes, if it truly is a new one every time. Yeah, the guest didn't walk out the door with it, but it took that sheet to produce it. It gets a little murky when someone says like, well, I use a glove when I grab this thing. Like, do I put the gloves in there? And it's like, oh, you could start layering a lot of things in. So at a certain point, you just need to say stop. But if that's easy to account for, if you were going to go for being super accurate, I would say you could count that as cost of goods. That is, once again, probably the art, not the science of bookkeeping. Stay consistent with it, though.
And I also think that's where your point about consistency comes in, that like once you make the choice to do it one way or the other, just making sure that you continue doing it that way is helpful. We have a question from one of 12 Caden Salvadas, now 6 Caden Salvadas, about the ratios between labor and COGS and overheads. We notably have not talked about ratios in this webinar yet, but I guess we can now.
Sure. Yeah. So that's into the like analyzing piece. This is like, how do I set myself up for success with these relationships, and how do I sort of just establish some ground rules about what this should look like? If you are going to get into the analysis piece of it, this is where we'll often, I don't remember who asked the question about evaluating the direct labor impact on cost of goods. This is where that would start to come to the forefront a little bit more. We don't necessarily have a benchmark for cost of goods and labor individually, but as a group, if you put them together, cost of goods and direct labor amounting to 60% or less of revenue is a really good target. I'd say if I were forced to put a specific numbers on it, I'd say it's more common these days for folks to spend more on direct labor and less on cost of goods. So it might be 25% cost of goods, 35% direct labor, something like that. But it really can vary by concept. But putting them together at about 60% combined, that allows you to spend about 30% on overheads, and that leaves 10% for profitability. And anybody who's heard about industry averages, 10% is not average, and we're not here to advocate average. And operating on thin margins, is part of difficulty in creating instability in restaurants. Now, I think that's more of a long-term view. I want to be very clear. Like realistically, right now, if you've been losing cash for a year, 10% profitability is fiction for you right now. Let's get to break even. Let's get to a couple of percentage of profitability. But as a long-term goal, I want to be looking at 60% primes combined, direct labor and cost of goods, 30% overheads, 10% profitability.
All right. It is 6:59, so I think we'll take one more question, which I think is, oh no, we have a couple. We have a raised hand among participants. Let me see, how do I do that? Okay, I have unmuted one of the Cadens.
Hello?
Hi.
Hi, how are you? This is a great class. I got a quick question though. When you said after COVID, raising the price, if you got an item that's $2 and you should be selling it for like $7, I have a real hard time with my core people that buy from me to going any higher than what I'm actually charging now. So what I thought of doing was adding something else like coffee that I can raise the price up on. But the base, what I have, it's really hard for me to raise the price. Definitely something I'm selling right now for $3 to be able to go to $5 would be kind of stretching it in the area. So what I got out of it was I'll sell coffee and increase on the coffee and make that kind of like the thing that I'm increasing on.
Yeah, I think that's a reasonable line of logic. I'd say if you're concerned about raising prices or you feel like that's unrealistic for your market, one, I trust you. Knowing your market, understanding what your market will bear is very important. You know, all these rules go out the window if people aren't willing to pay for it.
Yeah.
It's all about perceived value. It's less about, you know, actual inherent value. So introducing very profitable items to offset items that are not so profitable is a really great strategy. Another good strategy is if you have some third party that you sell through, or you know, Uber Eats, Grubhub, and also have in person. A lot of folks find that they're actually serving two different groups, depending on whether it's in person or third party. And as a general rule, folks who are purchasing on third party tend to be less price sensitive. So increasing prices on third party, especially if you're nervous about increasing them in person, that's a good way to test things out and see how it's received, see what the impact is on your total sales and your ticket average, things like that. That either might give you the confidence to raise the prices in person, or you might say, hey, I'm making enough now off the third party because I raised the prices. I can allow my in-person guests to still pay that lower price.
Thank you so much, everyone. So it wouldn't be a webinar if we didn't go over by at least 2 minutes. So here we are. One last question that I want to address is 1099 versus hourly W-2 employees. Does it matter? The answer is yes, it absolutely does. And that is going to be the subject of our next webinar, which is on April 27th. So 2 weeks from now. It matters so much, and I really would love to talk to you about it. We are going to have some lawyers from Toast who specialize in employment law talking about these and other employment law topics. So we would love to have you register for that, and we'll be sure to send that link out to everyone who's here tonight. And I promise I won't screw up the link like I did this time. So I think with that, we should start to wind things down. Please feel free to keep putting stuff in the chat if you have other questions. And I look forward to hearing from many of you so that we can set up some one-on-one P&L check-ins with Dylan. Jess, anything you want to close us out with?
No, I just want to again thank the City of Boston for their support with this initiative, and thank my colleagues Roz, Melissa Castro, Irene Lee, Dylan, all the Cadens, and I hope that you enjoy this information and join us for our future webinars.
Thank you guys so much for coming. We do have this recorded as well, so you'll be able to rewatch this if that's helpful. I'm really glad Irene's able to offer this service to you guys, and also know that the city of, also know that the City of Boston is able to provide accounting services free of charge for project-based situations. So we can't pay an accountant in perpetuity, but if you need somebody to help you get set up or QuickBooks or teach you QuickBooks, that's something we're able to do. And feel free to reach out to the small business team if that's something you're interested in. And we hope you guys have a great night, and we'll see you again in 2 weeks.
Thank you all.
Thank you.